Okay, lovely afternoon, ladies and gentlemen. My name is Roman Vasil, and I will guide you throughout this event today. We gather here at the NBS premises for this one-day special event, which brings together leaders and main actors in the realm of green investment and sustainable finance. Today, we aim to discuss key challenges, share the latest best practice, and explore the prepared next steps in this crucial field. So during the event, you can ask questions via Slido or do it by old-fashioned way, raising your hands. So not to prolong it a bit, so to kick off our event, I'm pleased to invite Rainer Martin, Executive Director of Národná banka Slovenska, to deliver welcome remarks and a keynote speech. So please, Rainer, the floor is yours.
Thank you very much. Yes, a warm welcome also from my side. My name is Rainer Martin, Executive Director, Národná banka Slovenska. And I'm very pleased and very happy to welcome you here today. So we managed to organize a very warm temperature outside so that you're all dutifully aware of how much climate change and global warming is really an issue for us. But joking besides, we would like to talk today about more practical challenges in greening regulation. So this event today is the third one in a series of events that we've been doing since the beginning of last year. So the first one was on climate sustainability, risks and opportunities, because there is a lot of focus typically on the risks that are associated with climate change and the transition, not so much on the opportunities, but there are, of course, a lot of opportunities also in the field of business. And then in March this year, we did another event on sustainability in practice, Road to Net Zero. So there was a lot of discussion also on financing, what can be done to finance the transition process and so on. And today we're looking more at greening regulation, practical challenges ahead of us. And these practical challenges, I think, are quite substantial because there is a lot of regulation coming our way. It seems to be getting more and more as we proceed. And previous to this discussion here, we had a closed-door event among stakeholders where this was also becoming a big issue. The complexity of the regulation, the challenges related to data, and the challenges related to getting the main story across why this really matters. So before starting here, I would just like to extend my thanks also to Julian from ISFC, International Sustainable Finance Center. And that's been our cooperation partner in all three of these events. And I have to say really a very big thank you from our side, because I think with your dedication and expertise, you're really an enormous help for us in moving this forward. So thank you very much indeed. Right, so you've seen the program, and I don't want to go through the program now again. I think this would be superfluous. So let me go straight to the keynote speech. And the keynote speech, this is maybe a bit of a strong, a big word for what I will deliver. Get that? Or let's not start from the conclusions. Yes, okay. Thank you very much. So this is work that has mostly been done really by, thank you very much, by Florian Horky. Florian is a researcher in the research department of the NBS. So we recruited him recently. And he has been working also on climate change and renewable energy adoption before. And I thought this is an interesting segue, a sort of motivation for the discussions that will follow. But I'll try to be relatively brief to have more time for the discussion that will come. So let me start with a more general observation. So as you can probably guess, I'm not really from Slovakia. I'm German by origin. And when talking to people here in the region, sometimes you, also in Germany, by the way, sometimes you get this notion, well, climate change, okay, we're not so affected, are we? Because we are not going to be threatened by floods and the temperature is still relatively mild. And So what do we have to fear from this? Well, unfortunately, that's not really true. Because if you look at the meteorological data, Europe is actually among the fastest heating regions in the world. And this part of Europe, Central Eastern Europe, is actually the fastest warming within Europe. So this is what you see here is basically trends in rising temperatures. So this is not a projection. This is not based on any fancy model. This is just really data that you can see. And the area around Slovakia, Czech Republic, Central Eastern Europe is warming up a lot more than the rest of Europe, by the way. So it is an issue. It is definitely an issue. And that has, of course, repercussions for us. Because, and this is also one of the reasons why at the NBS we are quite active in organizing such events, raising awareness, and also ramping up our analytical capacities in this field. So I'd like to use here a very nice quote by one of the board members of the ECB, Mr. Elderson. He was talking about actually biodiversity, but it also applies beautifully to climate change analytics. So he said, what we are talking about here, this is not some kind of flower power tree hugging exercise where afterwards we feel energized and we feel much more attuned with nature. This is core economics because climate change matters. It matters for financial stability. It matters for macroprudential, it matters for macroeconomics, and it matters also for price stability. This is economics. And sometimes when people say, well, what does the central bank has to do with all of this? Why are we bothered about that? Well, we are bothered because it's about economics, and we need to understand this. We need to understand what is going on here. So let's zoom in on what is most important, of course, for us, which is price stability. Core mandate of any central bank. Well, if you have climate change and hotter than usual summers, this will have a direct impact on consumer prices. Why is that? Well, the most obvious one is bad harvests, because you may have droughts, the crops are not developing very well, so the harvests are bad. Well, then obviously the prices for food goes up. This is pretty basic. And this is something you can see. I don't know whether you like chocolate or cocoa. I like chocolate very much. The prices for chocolate have gone up a lot. Why is that? Because there has been bad harvests in Africa, some of the main producing countries for this. But besides chocolate, there is also an issue here with energy, and this is what I want to focus on now. So the energy demand for cooling is likely to increase a lot as a result of global warming. And the energy demand and energy prices is one of the key drivers in European inflation in general. Right? Now, that leaves you then with the question of what type of energy do you want to use? And of course, until recently, we've mainly used fossil energies. This was the standard source of energy. Now, fossil energies tends to have actually higher marginal costs than renewable energy. But this is by now a fairly well-established fact. So if you have solar power, if you have hydroelectric power, this is cheaper in the steady state once you have it established. Of course, in the interim period, when you have the investment period, it has upfront costs, this is clear. But once you have it in place, renewable energy is cheaper. And there we come to inflation and price changes. It is also less volatile than fossil energy prices. So renewable energy adoption has actually two important benefits. On the one hand, it helps to reduce climate change because energy production is a key driver of CO2 emission and climate change. And at the same time, it can mitigate the impact of climate change, the economic impact. So renewable energy adoption is something that is very, very important. So that brings me to the question, how are we doing on renewable energy adoption? Unfortunately, we're not doing so well. So this is a pretty small chart, but you can, sorry, there is no pointer here. But what you see is the Central and East European countries are the ones in blue. And you see here the change in renewable energy consumption per capita over a period of 20 years. So from 2020 to 2022. And so the bigger the line you see here, the more development has been, the more progress has been made in adopting renewable energy. And you see for all the Central and East European countries, this has not been particularly impressive. Now, the case of Slovakia is, of course, a bit different because there is a large share of nuclear power in the country. So that may make the pattern look a little bit different, and that should be taken into account. But nevertheless, for the region as a whole, there is less progress than we see in other parts of Europe. And the next question I would like to answer then, or address, is what drives this? So why is renewable energy adoption been slower, less fast than in other parts of Europe? And this has a lot to do with the structure of our financial sector. Because in Central and Eastern Europe, the financial sector that we have is heavily bank dependent. We have almost entirely banks that serve the financing needs of the economy. That's a general European issue compared, for example, to the US, but in Central Eastern Europe, it's even more pronounced than in other parts of Europe. Now, what does it mean for renewable energy adoption? And this is a little exercise that was done here by my colleague Florian Horky and Jalko Fiedermutz, both at the time from the Zeppelin University in Germany. So they looked at the change in capital market development versus the change in renewable energy consumption per capita, again, over these 20 years that I just showed you. And I think it's quite an interesting finding because what you see on the left-hand side, so this is the capital markets versus renewable energy, and you see a positive trend line here, right? So what does it mean? Well, if you have a positive development in capital markets, you also see, generally speaking, a more positive development in renewable energy consumption. On the right-hand side, you see the same for financial institutions. A financial institution, in this case, means banks. And there you don't really see that. The opposite. You have here actually a slightly negative trend. So I would like to make you aware, of course, or be cautious that one needs to be, there are other issues here, right? So this is not a univariate causality. This is not the only factor that plays into this game. Other factors matter too. But Horky and Fiedermutz looked at that in a lot more detail also. So they have a whole paper, which I quoted here. And this link, so the negative link for banking dominance and the positive link for capital market development still holds. And this is interesting. So let me go a little bit then behind the reasons. So why is this? Well, there's a couple of relatively obvious reasons that come to mind. The first of these reasons is that banks tend to have well-established relationship with existing customers. That's not a bad thing at all. That is fine. But customers in this case, of course, also include fossil energy producers. So there is an element of inertia here. Once you have this business relationship established, you tend to keep it. This is a normal phenomenon, not just in the banking business, I think in all kind of business relationships. The second aspect that reinforces this is that renewable energies tend to be associated with a relatively higher financial risk due to high initial investment costs and ambiguous prospects. Now, you probably think back and said, hang on, 5 minutes ago, the guy told us that actually this is such a great investment and it's cheaper and everything is much better. Yes, but during the investment phase, during the startup phase, of course you have risks. If you have new producers of renewable energies entering the market, whether they survive or not is not a guarantee. By definition, this is always when you have startups. New companies have a higher risk ratio. This is that. And if you want to have a nice example of this, where the risks are, you can take the German solar panel industry, which was a wonderful example of success about, I think, around 15 years ago. And then China started to use a lot of subsidies, and now it's dead. The German solar panel industry has disappeared. And that is bad if you were involved in this as a bank. So there is a risk assessment, which is understandable. And related to this is the third point, that capital markets, so market-based finance, typically allows for greater investments in innovative, but potentially more volatile and risky sectors. Again, this is a standard finding you have. So all of that helps to explain this positive link between renewable energy adoption and capital market development on the one hand, and the more negative link between dominance of the banking sector and renewable energy adoption on the other. So what does it mean from a policy perspective? Well, there's basically two ways forward here. The first one is that you aim to have more market-based finance in your country or in the European Union as a whole. And of course, this is not exactly a new idea. We've been discussing about capital markets union for 20 years now, roundabout. But the topic is still there, and it's still a very important issue. And the second way forward, if you accept that for probably quite a long time, the banking system will become will remain the dominant financial intermediary, you need to think about how the banking system can be made more supportive for renewable energy and the green transition in general. So let me first look at first at the first point. This is the more market-based financial system. Well, have we done any progress here over the last 2 decades? No, unfortunately, not really. So, in fact, this is based on IMF data here. So the IMF provides across all countries in the world so-called financial institution scores and capital market scores. And to put it very bluntly and simply, the higher the score is, the better the banking sector or the capital markets are doing. Okay. So if you then look at the capital market scores for these 5 Central East European countries in 2000 and in 2020, there was a tiny bit of progress in the Czech Republic. And for all the other 4 countries, for Hungary, for Poland, for Slovakia, and for Slovenia, there was actually a regression. So the score actually went backward. And in the case of Slovakia, unfortunately, even the starting position is the lowest by far within the region. So unfortunately, there is not really a lot of progress that was made, rather the opposite. So it's more that we see an increasing dominance of financial institutions or banks. Because if you look at that, you see actually an improvement in all of the countries. So the banking sector became better in a way, but also more dominant within the overall financial sector. Then, of course, the other question is CMU. Yes, the European Solution, Capital Markets Union. But as I said, this is something that, it's been in the making for many, many years without too much progress so far. Now, what to do about banking regulation? This is then the other way forward, the second option. If we can't get a thriving capital market, then maybe we should do something about the banking market. And there are quite a few, I call it here, green banking policy instruments. This is based on a sort of typology that was set up by two authors, Park and Kim, a few years ago. I just want to go very briefly through them, and then we can discuss it in more detail in the rest of this event. So the first one is a macroprudential policy. This is something that includes, for example, stress testing, and Christopher would be the man to ask any details on that topic, or differentiated capital and borrower-based measures. There have been some practical examples of this already done. So, for example, in the Slovak Republic and in the NDS, we have established a green DSTI, a debt service to income ratio. But still, this is largely under discussion. So we also had an event on this actually about half a year ago. There's a lot of discussion, but not so much has been practically done. Then microprudential, core banking regulation. I don't want to say much because this is the main topic of the workshop today. And then you have market making. So this is about guidelines for the market that encourage more green banking activities. And the extreme intrusive form of such banking regulation would be credit allocation, where you require the banks to give, for example, minimum lending shares to green sectors. I mean, that to me sounds a little bit like central planning, and not surprisingly, this is done by, for example, by the People's Bank of China. They are doing these sort of things. So that's a pretty extreme form of green intervention, which I think nobody is really considering, at least in Europe. So let me conclude, and then we can start with the discussions. So the CEE countries are disproportionately, unfortunately, affected by the impact of climate change, and they will face significant economic consequences in many regards, and including on inflation due to food prices, due to changes in energy prices, and so on. The speed with which energy production becomes green in this part of Europe is slow, quite slow, actually. That is neither helping climate change nor the adjustment process for climate change. So this is definitely a deficiency that we are facing. We are facing an overall lack of sustainable energy investment in this region, and more risk-minded capital market or market-based finance would be helpful in this regard. But as I mentioned before, the further development of capital markets is very important, but also unlikely to happen anytime soon. Now, I don't want to be dismissive of this at all. I mean, any progress that we can make on this is welcome, and we should not stop our efforts and our endeavors to make progress in this field. But just, don't expect miracles to happen here anytime soon. So that leaves us with the main question then for the rest of the afternoon, which is how can banking sector regulation be optimized to fill the gap, to stimulate investment, in this case, renewable energy production, but also green investment more generally, while, of course, retaining an appropriate financial sector risk balance, because what you do not want to generate is, of course, a high-risk financial bubble, as was happened occasionally in the past. So thank you very much for your attention, and I wish you a productive rest of the afternoon. Thank you.
Thank you, Rainer, for the compelling messages. We have one question from the audience to you. So, unexpected, but it's here. What are the tools and actions that NBS can implement at the local level, empowering the greening regulation?
The greening regulation in general. Okay, I mean, there's various things we can. I think one of the aspects is, of course, that we can raise awareness of the issues. This is something that we are doing in events like this and on previous events. This is one thing. Then I think it needs to be differentiated between where the NBS is solely responsible and where it is jointly responsible. So on the things where it's solely responsible, so for example, macroprudential policy, this is something where we can be active, proactive ourselves. In the field of capital market regulations, this is also something where there is more discretion at the national level. In the field of banking regulation, of course, we're bound within the SSM and the respective regulatory environments. And I think there we can make our voice heard, of course, to implement this. And then there is a lot of, say, hard work on a daily basis, which our colleagues in the supervisory department know a lot better than I do, to discuss with the banks and to foster also the discussion between the banks and their clients to implement the regulation and to make sure that the necessary data, for example, is available and that the regulations is understood, because this is the starting point, really. So complex answer, sorry, but I think it was a pretty broad question as well.
I think so. Thank you for answering the question. Are there any other questions from the audience? And if no, we can move to next program on our agenda, and it's on-stage interview about how we can get to greener balance sheets, monitor and enhance the green investments. We have the pleasure of hearing from Mr. Bernhard Magne, Senior Economist at EIB. And the interview will be moderated by Jan Klačo, Head of Financial Stability Research Section at NBS. Please, Jan, if we are ready, the stage is yours, and audience, don't hesitate to ask questions.
Thank you very much. Okay, so the mics are working, hopefully. Yes, as you can see, there is a link to the Slido, so please feel free, as of course, these events make sense if there is a discussion and both sides learn something from the other. So before introducing Bertrand, first of all, thank you very much to all of you that you come. I see that you've decided to choose green topic instead of football, which is much appreciated because it's not so straightforward decision to everyone. So really, really appreciated. So let me first of all introduce Dr. Bertrand Magne. He's a senior economist in the economics department of the European Investment Bank. In March 2023, Bertrand was appointed co-rapporteur of the subgroup 3 on monitoring capital flows of the platform on sustainable finance. He specializes in the green transition and policy assessment. He worked previously as senior economist and energy specialist in various international organizations like the OECD or the UN. He's also an expert advisor for the World Economic Forum, so I think he is really the right person to talk about green regulation and green investment. So please, again, feel free to ask. Now, when I also opened the webpage of the platform, there was information about the Green Deal, about the targets, and that we are working on the monitoring framework, but maybe first of all, let's start with from the beginning. So please, Bertrand, could you just describe a bit more that was the role of the platform on sustainable finance and what to imagine under this platform?
Certainly. So first of all, good afternoon, everyone. Thank you very much for giving me the opportunity to explain what we are trying to put in place here in the context of the platform. Thank you. So what is the platform about? So first, it's the platform itself. It's an advisory body to the Commission to advise on what a comprehensive sustainable finance framework should be like. And it's enshrined in the taxonomy regulation. So the creation and the maintenance of a platform is an obligation for the Commission. and it comprises about 100 members and observers that gather for a 2-year mandate on a regular basis. Activities on the platform, in the current platform at least, are divided in 3 work streams. So one has to do with the usability of the platform. We understand that there are lots of reservations. There are a lot of positive signals on how the taxonomy is actually implemented, but there are also reservations on how market actors at large can actually own the information. So there is a subgroup which is devoted to clarifying the extent of market practices that are now aligned with the taxonomy obligations. And I have to mention here the Compendium of Market Practices that was released a few months ago by the platform, an important document based on an extensive survey of various market actors. So that covers banks, corporates, the public sector, insurers, auditors, and others. It's a very comprehensive document that reflects on the actual changes in market practices in the adoption, again, of the taxonomy obligations. Then there is a second work stream on the platform, which is called the Technical Working Group. And this is the core of the taxonomy activities. So it's the group that defines those activities which are considered as sustainable and which are going to be progressively put into the taxonomy regulation. So as it stands, the taxonomy includes 170 activities, and there's a couple dozen more currently under examination. It's a scientifically driven effort. It's rather difficult and complex effort to define precisely what are the technical screening criteria that allow us to determine whether or not an activity is sustainable. Right? And beyond this, the purpose, of course, is whether or not to decide if an activity is eligible for sustainable finance. And then there is a third work stream, which is the work stream I am co-leading with my partner, Carlos Olming, who is the head of policy, sustainable policy in the Swedish bank SEB. And this third work stream, which I'm going to talk through now, is about putting in place a system to monitor periodically and systematically the capital flows that go into sustainable investments. That's in a sense what we are doing. And again, it's part of the taxonomy regulation to maintain the platform and to start the systematic monitoring of those capital flows, because the whole sustainable finance framework in Europe has been in place for 3 years, and now is the time to understand where we stand, to what extent it's being picked up by market actors, and if we are actually making progress towards the achievement of our Green Deal objectives.
Thank you very much. And so let's pick up here what you mentioned, that the aim is to monitor green investments. And of course, the main target that we have in mind are those targets set by the European Green Deal, the net zero emission by 2015, and to reduce net greenhouse gas emissions by at least 55% compared by 2030 compared to 1990. So where do we stand in terms of green financing? How much private and also public investments are we lacking at the moment to achieve this goal?
So let me put up this slide first. So the answer is, first, we are doing quite a bit. It's not that we are doing nothing. There's a lot of money going into various environmental objectives. So there are 6 of them which are identified by the Green Deal. And there is a 7th one which came only recently in policy circles, which has to do now with the strategic autonomy of Europe and in the development of more domestic supply chains for those technologies and commodities that are considered strategic for the European Union, to disengage from countries which are considered less reliable to supply those goods in the long term. But let me come back to the first 6 ones. As you see, the climate mitigation is the big bucket in all this, right? And so currently we spend about 800 billions on climate mitigation. It is the foundation of those transformations we are talking about. It's most important. It captures already a lot of money. So now we heard about the renewable deployment in Europe. So there are different situations, admittedly. Not everybody starts from the same point, but there are still a lot of money going into the clean energy space in particular, which account for about 400 billion euros at the moment. And it's only growing, as we saw last week, confirmed by the International Energy Agency. And now 95% almost 95% of energy investments are actually clean energy investments, right? So because we start from in some context from a low base, the transition from polluting fossil to green will take a while, but there is clarity on where we need to put our money now. Okay, from an investor's point of view, from a utility point of view, investments now are clean in Europe, and it's just a matter of time before the energy supply becomes clean, at least for the electricity side. Yes. Then, of course, if we are to meet the Green Deal objectives, so decreasing by 55% our emissions in 2030 and achieving carbon neutrality by mid-century, then you need more money. We are not there yet. And we need to scale up investments by at least 500 billion euros here. Overall, if one is to address all of the different environmental objectives, it is assumed that we need something in the order of 600 billion euros. There are different estimates here, but these are generally well-admitted ballpark figures. And then that applies, of course, to other environmental objectives, but the needs to achieve those goals, because they tend to be a little less ambitious, and perhaps they are very important, but they are less transformative in the way we live in some way. But they actually feed into serving the climate objectives very much so. So circular economy has a lot to do with addressing climate change. Yes. So there are lots of interdependencies across those objectives. All of that requires money, as I said. And what I want to mention here is the timing is also very important. The timing of disbursement is essential. So one has to understand that we are looking for a very deep transformation of the way we consume and produce goods, but it does not have to happen overnight. Decarbonizing electricity supply, then energy supply, it's already ongoing. Electricity is becoming clean, renewable expansion is growing, not at the right pace, but still growing quite fast. Mobility, personal mobility is also picking up. We have a very dynamic electric market, electric vehicle market now. You have heat pumps also being adopted relatively swiftly. So you have a lot of components in industry. You have a lot of energy efficiency measures that are put in place. They have been there for a long time. Those big manufacturers, they know what they are doing. So a lot of people across the board are doing things right. It's just a matter of scaling things up. But not everybody is yet ready to embrace new technologies, oftentimes because those technologies are not readily available. So not everybody is ready to absorb big investments. This is why we are trying to do something difficult, but it will come only progressively, because we cannot, and it's not even desirable from an economic standpoint, to do everything at once. Yes, so efforts need to be conducted progressively.
Thank you very much. So, as we see, there is still a lot of finance needed, and so you will have a lot to monitor. So what what's monitored? What is covered by this monitoring framework we are talking about?
All right, so let me take you to the next slide. So we are trying to put in place this systematic monitoring of money, and there is a focus on private money, recognizing that 3/4 approximately of what is needed in overall investment needs to meet those objectives should come from the private sector. So the private sector has a key role to play to deliver on those objectives. Not to say that the public sector has nothing to do. On the contrary, it has a key role to play to support innovation, to help the first movers and so on. But the bigger effort, and also this is where the potential is coming from the corporate sector. So this chart is meant to depict schematically what this monitoring is about. So you have this big green blue bar, the green investment needs, and on the left-hand side you have where we stand. So there is a certain proportion of public investments and corporate investments that are currently being put into this. We are going to track some of that. So the monitoring and the data availability only allows us to track some of that. Some other aspects are not yet subject to regulatory obligations and are more difficult to track on a systematic basis. But eventually, there are two ways to decrease the investment gap. Is first to enlarge the set of companies we are going to track. And then, of course, hopefully, we want to see more and more money from those companies that are tracked that are going to direct investments into those sustainable investment needs. So that's the iterative process we are trying to put in place, essentially. Now, what does that mean? We said we focus on the corporate sector, and we also include a bit of public money whenever we are able to track it, at least for those public entities that are in the scope of the regulation. But that's a detail here. At the core of what we do is to keep track of what is happening in the real economy. We are going to talk about the financial side of things, which is going to enable those companies to meet their objectives. But at the core of what we do is the taxonomy regulation first. And there we say there are 170 plus activities that are considered eligible under the taxonomy. And we want to understand within those that are eligible, how much alignment there is for those companies that operate in those sectors, right? So that is a big component of what we do. We want to keep track on a regular basis of those revenues and then investments, CapEx, going to those taxonomy eligible activities. And then there is a second set of activities. There are first those activities which are, for instance, currently examined by the platform on sustainable finance that could become eligible in the future. So I cannot disclose here what is in the books, but there's a number of them that will also deliver on the transition. But we still need to define those technical criteria that will allow us to determine if they are eligible. So we put all this into account, and then we understand we are going to do this mapping with sectors and eventually by Green Deal objectives, and we'll understand where the money is going, where it's flowing. So through which activities, through which sectors, through which environmental objectives eventually, right? So this is the whole purpose of the framework. The other pendant of the framework we are trying to propose is what is happening in the financial sector. And then here there are a number of instruments that can be deployed and serve those investments. So we want to see where the investment is going from corporates, for instance, and we want to see which financial instruments are mobilized for different sectors. And depending on the sector, of course, there is going to be some preference, whether you want to issue bonds, you want to access more risky capital, you want to be supported in different ways, right? So we are going to look into the sectoral patterns to understand what is the current way to finance those sustainable investments, and if there are new instruments to be put in place or supported, for instance by central banks at the domestic level or at the European level. And then on top or next to all of this, there is the transition component. So everything which does not directly relate to the taxonomy, but we want to understand how much money is going to transition. A lot of those activities and companies, they are in transition. Their activities cannot be aligned with the taxonomy yet. Think about an oil company, a refinery. It is not aligned with a decarbonized economy, right? But they are, in some cases, making efforts, putting money into transforming progressively their activities. So they are not contributing significantly to those environmental objectives, but they are on their way to becoming greener, right? So we want to understand those companies that are now in transition, the financial institutions that are also in transition. They are greening their portfolio, for instance. And then there is the whole transition finance part, which connects those dots. How do we address the needs of those entities in transitions, and what are the instruments for them specifically to finance their transition? So the transition is an important component of all this. And the next slide explains in very simple terms what we are aiming for. In the short term, there is the big finance bubble, right? The green finance is yet not very large, admittedly. This is not at scale, okay? It's just an illustration here. You have, like I said, a lot of companies whose activities are not yet part of the taxonomy, so they cannot be considered sustainable. But they can do quite a bit to transition away from dirty activities to greener activities. Not yet fully green, but greener. That's the transition part. And as time goes on, medium term, long term, you hope to see a greener finance that will progressively take over what is transition finance. So you will hope to see more and more corporates aligning their activities with what we consider as sustainable. Eventually, in the long term, of course, we would like to see no company left in transition. So everybody will have made its aggiornamento, say, and will have then transitioned to something which is sustainable, and we are left with green finance only. So that's essentially, in the long term, the direction the monitoring is expected to take and to deliver.
Thank you. I think that there was one word mentioned by Rainer, that's complexity. I think that we can see that it's not only the transition, but even the monitoring that's very complex. And I think that for such a complex monitoring, you really need the backup of regulation. You already mentioned that how taxonomy helps, but I guess that also the other disclosure and reporting regime will be a huge help in putting together all the necessary data.
Yes, absolutely. So in fact, there are three pillars in the whole sustainable finance framework. You have to understand it like this. There is a taxonomy which defines what we consider as sustainable activities. So these are the set of defined activities. And then there is the reporting. So behind all this, and that's the complex system we are trying to put in place, overly complex in some cases, admittedly, but take it as a learning process for everybody, including for policymakers in some way. And this complexity is actually being addressed with a view to simplifying procedures and reporting templates in particular. So this is the second element, the reporting, right? We want to make best usage of the data that is going to emerge from this process. It is very complex, but we are trying to put in place a tool that will help policymakers adjust policies, simplifying, targeting a bit more effectively the tools that could support this and that sector or activity that are needed, that are ready to absorb capital, for instance. Yes. And then there is a third component, so the three pillars, the transition fund, the taxonomy regulation, the reporting aspect, the disclosures towards more transparency, and then finally the financial instruments that have to be mobilized to serve all this.
So let's hope that it will be a success of the monitoring. Maybe the last question that can be of interest for the audience, that when you expect the monitoring to become operational, so when you expect the first data to be outlined.
So there's a lot of data already coming in, because it's been 2 years that those companies, at least those that are in the first scope of the regulation, the bigger companies in a nutshell, 12,000 companies already are reporting on their activities, and there are good signals there. We know that there are already in the last 2 years there were about more than 400 billion euros devoted to those taxonomy aligned activities. It's quite a bit of money, and there are 500 big companies that do this. It's mostly driven by the utility sector, admittedly, but there are also some in the manufacturing sector. In mobility, the clean vehicle manufacturers, for instance, they are also putting investments where this is needed. Same for heat pump and other segments in the manufacturing sector. So there's a lot of activities which are already capturing money. We have that data now, and we start being able to put money on what is needed. Same for transition. We will have progressive disclosures on transition, and including for what the banks are doing to transition themselves. And in June, in the coming weeks, actually, the EBA will actually release the first set of data. So we will progressively include those packages into our own framework. Where do we stand? We are going to produce a final report. So this is stemming from our intermediate report, which was released a couple of months ago now by the platform. End of the platform mandate is December, and by that time we'll have a final report which will start documenting those items. So we start putting some data whenever it's available, and there is some that is available that allows us to understand already where we stand. Okay, it's going to be very incomplete because those reporting obligations, which is the subject, which is the substance matter of what we are doing, actually will be phased in progressively, but that will come later as of next year and so on. Without going into a very detailed criteria here, we are going to see progressively more and more data, more and more granular, and addressing more and more companies, essentially. So the answer is, as of next year, there is going to be some implementation of this monitoring, and we are discussing with the Commission and other stakeholders which form this is going to take. What is the nature of the document or the information that is going to be? And then we are going to make it with a view to make it a policy tool again that will allow us again to track where we stand.
Thank you. We received some very interesting questions also from the audience, so let me turn to those questions. I will need to do some cherry picking because there are several of them. How do we calculate the amount of necessary investments to reach Green Deal targets?
So there are different. It's a relatively heterogeneous approach depending on the objectives here. But people usually resort to models. So big models that are meant to represent the economy, and some have a climate focus. So you have a very extensive representation of the energy sector, for instance, which is at the core of this. And then you put a lot of data, you have a lot of assumptions to understand basically the pace of technology deployment and how you can actually progressively remove dirty activities with cleaner ones. So, and the same goes for other environmental objectives. They have a different focus. But basically, you compare what the trend we are currently seeing with what is needed to achieve a given target. So if I want to decarbonize down to zero eventually by 2050, then that means you need to go well beyond the current levels of efforts. And that's what allows us to determine the gap between a trend and what is needed to meet policy goals.
Thank you. Do you think that the new guidelines from ESMA on funds labeling can potentially lower the investment gap?
So again, without entering to confidential discussions on the platform, there's a lot of. I mean, we recognize the importance of funds to deliver on those transformations, but the taxonomy alignment is very limited for now. So and there are lots of problems with the labeling of funds. So the platform and the Commission and ESMA and others are now reconsidering the labeling to clarify and perhaps to focus on what could be taxonomy aligned, what could be transition focused, for instance, for some funds. And so we recognize that the funds were not able to pick up on the transition objectives very much yet, but for some, they are still doing a lot on sustainable investments at large, right? But it's just about defining different sets of criteria to clarify again the positioning of each fund. So yes, we hope to see an improvement there.
And maybe the last question that I like, because we can mention SMEs. Are there any EU initiatives to encourage SMEs to seek green finance?
So the listed SMEs are actually under the scope of the current taxonomy regulation. So they have the same obligation by 2026 to start reporting on what they do. And so it's a small set of SMEs, obviously, compared to the millions that form the quintessence of our economy in Europe. And there, again, this is not set in stone, but there are proposals in the books to progressively phase in more and more SMEs on a voluntary basis, and possibly with simplified reporting templates, because we recognize, and that was actually a part of the discussion we had previously, that the complexity is can put people off, even for very large corporates that have the means to conduct all of the assessments they need to report. But it's even more difficult for smaller enterprises. So there is going to be some simplification, some adaptation of procedures for a larger set of SMEs to be progressively part of the regulation. But this is a general movement towards the Green Deal objectives, towards a different way we consume and produce those goods in the economy in general. It does not only concern Europe, I have to say. It concerns many jurisdictions across the world now. So there is a momentum behind it. There is money, more and more money going into those activities. But there is a lot of efforts still, admittedly, to have all of this fully owned by all of the actors of the economy, on the real economy side and from the financial institution point of view as well.
Thank you very much. I think that's a nice end of this on-stage interview. Basically, we were talking about like regulation, data collection. So also, I guess in the audience, a lot of you will be struggling with filling the templates and with gathering the data. So please, when you will struggle, just think about Bertrand and about the bigger goal that we want to achieve. So thank you very much again, Bertrand. Thank you very much for the discussion.
Big applause for Bertrand and Jan for the engaging discussion. And now we will move to our expert panel discussion on the implementation of the sustainable finance framework and disclosure regimes. Our distinguished panelists are Chiara Del Prete. She will join us online, and she's chair of the EFRAG Sustainability Reporting Tech and chair of the International Forum of Accounting Standards Setters. Stefan Sengelin, interim head of Department of Green Finance and Sustainability Economy of BMK. And Christopher Koch, head of Stress Test Experts Division at the ECB. And the panel discussion will be moderated by Julian Top, Chief Operating Officer of International Sustainable Finance Center, our partner in crime in this event. So, the moderator, stage is yours.
Good. Can you hear me? You can. Okay. Partner in crime here, indeed. Thank you so much, Roman, for introducing all my speakers as well, which I actually just have written notes how I was going to do that, and I don't have to. So this is good. Chiara is online. Do we know?
Good afternoon to all of you. If you can hear me and see me.
We can hear you. We don't currently see you. And we can see you now as well. Amazing. Good. Okay, so that's all of us. So thanks for the introduction. I might maybe mention a little bit more about your background just to set the context. As you have heard, my name is Julian Toth. I am from the International Sustainable Finance Center, which is a think tank focusing on research and education on these topics, on sustainable finance, also sustainable finance policy regulations. In fact, my colleague Linda and I are also actively engaged in the platform on sustainable finance, where Bertrand is one of the key people working on the regulation. And it's maybe just to touch on the previous discussion, which I, even working on these topics, actually think is really insightful, especially because today we'll be talking about the implementation of the policy and regulations, right? And I have been not only moderating, but been part of discussions like this quite a few times for the past, let's say, 3-4 years. And it's really nice to see that we are now going into implementation and very tangible steps, strategies, discussions on how to do things. Because for like 2-3 years, it was all about what it is. What is it exactly? What will happen? And now suddenly you have Bertrand here actually showing you specific examples. And that's the story here, that this is happening. Companies are using it for financing and actually for transition planning, and the regulation is being implemented or is being absorbed really practically, which is actually really exciting to see. Just to maybe briefly mention to Rainer's point as well, we as ISFC are also really glad to be able to partner on these topics, because unlike you mentioned you're from Germany working here. I'm actually from Slovakia, but I haven't lived here for 15 years. But working on these topics internationally, is really nice to see that the central bank is actively involved in these topics. So I think that's crucial. And okay, good. All said. And we can now move to the discussion. So as you already heard, I mean, who we have on the panel, but maybe just to mention, because every time when I moderate discussions, I get the CVs of speakers, and then it's usually wealth of experience, and it's so difficult to extract exactly the most important points. But here we are talking about the implementation of policy and green policy and regulations, and we will focus mainly on the practical aspects of adoption or maybe application of these, but also challenges, some of the bottlenecks, what has been working, what hasn't, what we can do, but also trying to look for, to have that forward-looking approach to see how things can be implemented even more efficiently. And for this, we have a very good mix of panelists. So I will just start with you, Chiara, briefly, and I do hope you can hear as well, but hopefully,
yes.
Very good, because Chiara Del Prete was appointed chair of the EFRAG Sustainability Reporting Technical Expert Group, and is also leading the EFRAG Sustainability Reporting Technical Activities. What this means in practice is you may be one of the leading experts on sustainability reporting in Europe, in fact, and also lecturing, I think, on these topics, I believe, at Bocconi University, and also being with EFRAG, which EFRAG developed the corporate sustainability reporting standards and ESRS as well, and we will hear about that. This is actually going to the source of this, so this is really good. And then we have also Christopher Koch from the European Central Bank, who has worked and has led the stress testing division at the ECB, which, as we discussed briefly today as well, that has, I mean, a couple of years ago also included the climate stress testing, but there are many other tests that have been done in the past, going all the way to cybersecurity, I actually see. And it will be really interesting to hear about how the ECB, and especially how do you even implement the new regulations and the implications of regulations into climate stress testing, right? Because this is, again, different things coming together. We also have Stefan Sengelin from the Climate Action, Environment, Energy, Mobility, and Technology Ministry in Austria. Long name, but it's covering really important things. And it's actually nice that it's mentioned, all of these aspects. And you're environmental economist by background, but also you actually have worked on the EU taxonomy from the policy side or from the ministry side for basically since the start in 2018. And also you're the member of the steering committee on Green Finance Alliance, I believe. And so maybe just to briefly wrap this up, someone could maybe argue, well, that's a good panel, but there's no one from the corporates. Well, you could say that, but to be honest, not only EFRAG, as I know, Chiara, very actively engaged with consultations and actually speaking to the market. Same also ECB, but also being the Green Finance Alliance. These are people working with the regulations, hands-on, implementing it at the country level, but also talking with corporates for that feedback and for consultations. And this is something we will touch on today as well. Very good. Maybe just a reminder, there's the Slido you can use. I actually have seen a lot of questions from the previous discussion, so I'm very happy about that. So let's kick out today's discussion. As I said, we want to touch on the challenges. We want to just touch on some of the opportunities that even Rainer mentioned in the beginning, but also would be interesting just to set the context slightly better. And I would kindly ask maybe you, Chiara, to start, especially coming from EFRAG, being one of the authors or people working on the CSRD. Can you maybe share what exactly are the latest updates when it comes to implementation? Because you do talk to the market, you see what the companies and corporates are doing. So what's the latest on the implementation challenges for CSRD and the ESRS? And maybe what are some of the milestones, by the way? What do you think have been the achievements or success so far?
Thanks a lot, and thank you for the invitation. Well, of course, since the issuance of the Delegated Act in July 2023, we see now that the companies, at least those that are in the first wave from reporting periods 2024, are heavily involved in the implementation activities, well advanced in their materiality analysis, in the definition of what needs to be included in the reports, despite still many uncertainties from the legal point of view, because not all the countries have completed the enactment of the CSRD itself, and despite the fact that the auditing framework is still taking its shape only now. So despite all this uncertainty, we see a very good level of cooperation and an increased level of preparedness in the companies. I would say big achievements after the release of all the standards. I would mention the 2 exposure drafts for small medium enterprises, which will also play a very relevant role considering the business and economic structure of Europe in the transition to a more sustainable economy and to the Green Deal. So these 2 standards, in particular, one of the 2, the voluntary standard on small medium enterprises, is expected to provide a standardized approach to collect data from various fronts, including the banks. And I know that this is very important for the audience I'm speaking to. So we have the ambition with this standard to support the reduction of duplications, and we have seen several questionnaires, not all consistent, and so these we hope will be accepted as this standard also for the banking industry to collect the needed data. Then, of course, the launch of an exposure draft is still the first step, and then there are several other steps. But I would say that this is really has been incredibly well received by all the different stakeholders involved, because it's also responded to the European Commission's objective of reducing the burden for SMEs in particular. Another achievement is the almost completion of our digital XBRL taxonomy, which is another important piece of this puzzle. we will deliver it in the final advice from EFRAG to the Commission before the end of July. It will be really an element of innovation in the way sustainability information is consumed. And we have also the ambition, if ESMA will follow our advice, because they have the task of setting finally the digitalization rules, we have this ambition of making narrative information comparable and structured. And that's the way the standards have been written to support an efficient digitalization. And we see also that others, including the IFRS Foundation, has followed our recommendation to increase the level of granularity in the tagging system, so to come closer to us. Perhaps, I don't know if I should stop here and then speak about our implementation support in the next question, so to leave space also to the others. I don't want to,
Sounds good. No, that sounds good.
to exaggerate.
It's too many achievements to go through then, so that's understandable. No, that's interesting. So I am definitely then hearing there's a bit more work now when you mentioned the taxonomy also being integrated in the work of EFRAG. So I see a bit more activity on the interoperability as well, which has been a big discussion also in terms of scope, as you mentioned, now expanding more onto SMEs. I'm a little bit surprised, I must say, when you say that you get very positive reaction by the companies, especially when we move on to SMEs. But we can discuss that a little bit in more detail. And so, as you mentioned taxonomy, and I will now go to Stefan because taxonomy has been core of your work, or one of the main pillars, let's say. But again, coming from these from the ministry, essentially from the government level now, it's quite interesting because EU taxonomy would normally connect to, financial reporting, corporates and alignment and so on. But I would be very curious to hear what Austria has been doing, or maybe how you have implemented taxonomy in your work.
Yeah, having a regulation in front of you as a ministry is always a kind of dangerous area, because it's a regulation and you're not supposed to interpret it on a national scale. So you're not allowed to produce any guidance documents or anything. But on the other hand, you have the companies which have a lot of questions and which come to you and not to the Commission, or also to the Commission, probably. So we try to put some implementation support online, and we started, as you mentioned before, in the beginning it was a lot of explanation. It was explaining the framework and explaining how what's in it, what are the criteria, and so on. There's an abundance of material. You have the level 1, the regulation, you have the delegated acts, you have a lot of FAQs, and you have guidelines on massively. So the first step is usually to get a step back from this reluctance and take the fear, and that people and stakeholders confront themselves with this material. And you don't read the whole Wikipedia either. You just consume what's relevant to you, and that's the same with the taxonomy. You have to pick what's relevant to you. And what we did is we did some webinars, general ones and more sectoral ones. We included our environment agency, for example, to explain technical screening criteria. And we did also a first assessment of taxonomy alignment, which I'm quite proud of. We have in Austria screened through the sustainability reports, and being with the taxonomy from the start in 2018, and then seeing that it's actually happening in the sustainability reports, it's quite interesting. And what we've seen is that we have quite a low benchmark in revenues. It's about about 13% in the companies, but it's an increasing number with CAPEX. So it's 31% in CAPEX, which is taxonomy aligned, and which gives a forward-looking perspective and quite a positive perspective on that. And on the other side, we have this corporate perspective, but you shouldn't leave out the public side. So we have the public budget, which is also quite challenging. And for example, we have the green bond in Austria, and a lot of investors ask how much is the taxonomy alignment of this green bond. And to be honest, it's a very hard question to answer. So because the data in the public side is lacking a lot. But together with the Ministry of Finance, we are currently working on a so-called spending review, focusing on the taxonomy side of the budget, of the public budget. So you shouldn't leave out this very dominant financial asset in the capital market as well.
So it's a big part of that is education, then, and maybe even leading the discussion with the stakeholders, I think, on the topic, even opening the discussion.
Exactly.
I'm just curious if I can ask, so how come, or why is it exactly your ministry? If there's Ministry of Finance as well, if there's Central Bank, for example, I don't know how involved they are.
A very interesting question. I mean, in the beginning of the negotiation, it was in 2018, I think, or 19. We had the Austrian presidency, and we had the discussion with our Ministry of Finance, who does what, and we negotiated that we would cover taxonomy, and Ministry of Finance would cover SFDR benchmarks and so on.
Okay.
So. Since we knew climate criteria, the environmental perspective very well, we separated this in Austria. But I have to admit, there's a very close cooperation between Ministry of Finance and Ministry of Environment in this respective. So we easily interchange positions.
That is definitely crucial, and maybe just for the context of, for example, it's interesting to also see in Czechia, it also started with Ministry of the Environment, then it moved on to the Ministry of Finance very recently, I think last year, which I think also shows in a way how suddenly sustainability, while through financial regulation came as an environmental topic, and it's suddenly mixing different disciplines, and it's actually quite difficult to say who's the expert, who owns the subject. Okay, good. So that's quite interesting to hear about the beginnings, and I will move to Christopher now. Climate stress testing. So we are now here on the ground of the Slovak Central Bank or National Bank, and it's, to me, I have never worked in the central bank. I have never been involved with stress testing or climate stress testing, but that sounds like something you need a lot of data for, and really good quality data, right? So we can actually prepare the modeling very precisely. And now, at the same time, we have all this regulation, which actually, if you think about it simply, it's focused on transparency and production of data and more information in the market. So my question for you, how did it help, or how exactly does all this new regulation, green policy, how does it fit into climate stress testing?
No, thanks for the question. Thanks for inviting me. It's a pleasure to be here. So indeed, as you mentioned, data is really a key foundation for if you want to do stress testing in general, but climate stress testing definitely. It's kind of the starting point if you want to do scenario analysis, stress testing, and in the climate context, we think that scenario analysis, forward-looking analysis is a key component for our supervised institutions, our banks, to really understand how they will be affected by the green transition and the climate change. So from that perspective, I mean, we have run a couple of exercises now, one in 2022, and now we just completed another data collection exercise focused on a climate scenario analysis that we are conducting. And I think one of the key findings there was that banks are struggling. I mean, we also we know these are early days. Banks still need to get their heads around how to retrieve climate relevant breakdowns of their, exposures from their systems. So we also framed it very much as a learning exercise, and then these and also for us as supervisors to see how can one do this in the best way. But I think a key takeaway from those two exercises is that data is really it's a challenge for banks to get relevant data, say for example on greenhouse gas emissions, which is a key factor in if you want to do credit risk modeling or see how climate change could affect their credit risk portfolios. And what we see, for example, is that banks report that say around 70% of, we ask them for counterparty specific data on greenhouse gas emissions intensities, and 70% or 80% of those data that banks reported were based on approximations, estimations, so not really on actual data, but on proxies or estimated approaches, which is quite a high number, which of course gives rise to a lot of uncertainty whether the numbers are actually correct. And we also asked for counterparty specific data, and we looked at, say, so banks exposed to the same counterparty, and looking at what they estimated, for example, in terms of what that counterparty produced in terms of greenhouse gas emissions, and the numbers were all over the place. So which seemed to suggest that it really matters what type of approximation techniques you're using. So from that perspective, we think that these reporting standards that are being introduced now will be very helpful, because we see that banks are struggling. So and from that point of view, we say that the European Sustainable Reporting Standards have a kind of a double role, both in terms of say on the one hand, banks are of course also obliged to report ESG or disclose ESG information, and that in turn would also help us assess the financial impact. But maybe more importantly, banks would also benefit from the ESG disclosures from the companies or from their clients. And we think not only for climate stress testing, but for supervision more broadly, and say the availability of ESG data is really essential for banks to manage the risks that they will be facing, both from a transition risk perspective, but also from a physical risk perspective. And we have issued some guides outlining our supervisory expectations, both to how banks approach climate stress testing, but also how they approach risk management or climate risk from a risk management perspective more broadly. And there, I think, for banks to manage this properly, they need good data, and I think that the disclosure requirements will be a major stepping stone for banks. Also, for example, on emissions data, as I mentioned, but also for disclosure of transition plans, which is another key element for banks to manage the risk properly. I think it will. So that will be. So from our perspective, this is going to be really a fundamental game changer. It's still not enough. We also still encourage our institutions really to engage proactively with their customers to really understand what are the transition plans, are they credible? Because on the one hand, it also creates a lot of opportunities for the banks if the companies have credible transition plans. It's an opportunity to help them in the financing of that transition. But of course, if they don't have credible transition plans, it will eventually be a risk for the banks, and maybe then they need to consider whether they should keep financing those companies.
So it's interesting to hear, because what you're saying is also that engagement there is crucial, but it's not only engagement by banks with companies, but also with the topic, right? Because even climate stress testing as a process is fairly new, I guess. And when we talk about data, I mean, the quality and maybe the precision of data is definitely something that is still being built through the regulation as well. But essentially, it's banks maybe not only not having data, but also maybe not being familiar with the topic or what exactly climate risk can mean, what are the implications. So I think essentially what we're saying is that every other or the next climate stress testing should be more and more precise in terms of modeling. Maybe one thing I should have mentioned in the beginning is, because we have people here from different sectors, I think. Does everyone know what a climate stress testing is? Because I actually personally, I've never been part of one. Could you maybe briefly just explain, if it's possible to briefly explain? I don't know.
Yes, okay, I'll try. I mean, the stress test in general is it's typically a hypothetical exercise. No, you give, say, the banks in this case a scenario, typically an adverse scenario, economic downturn, and then you ask them to translate what that means for their business, for their loan exposures. Will that create, how much loan losses will that create, say, over the horizon you're considering, given the scenario? How much profit will they be able to generate on that specific scenario? And then ultimately, what is that the impact on their capital, for example? In the climate exercise, it's a little bit more exploratory in a way, and also I think typically the more solvency stress tests that we are conducting as supervisors are typically 3-year horizons, in the very short term. But of course, when we talk about climate risk, climate change is a long-term phenomenon. It's typically, when we think about this, it's 30, 50 years out in the future. And of course, that is not a horizon that banks and supervisors, for that matter, are typically, we're typically only thinking about 3 to 5 years. So of course, that is a new dimension that we need to consider. And there, okay, the scenarios that we typically consider in the climate context is really about how, that we typically base it on the network for the greening of the financial system that creates a lot of, say, climate scenarios that typically focus on, say, whether climate policies are implemented and what that means for, say, carbon taxes, for example. Say in a kind of a front-loaded transition, carbon taxes will increase in the short term, but that will then reduce, say, physical risk in the longer term. Whereas if we just keep policies as they are, okay, carbon taxes may not increase so much now, but that would in turn generate a lot of say, physical and transition risk later on. And that's basically what we ask banks to then consider. How would that affect your business and the loan losses? Also, physical risk scenario, which is basically where we ask banks, okay, there's a flood in Europe. Where are your say, collateral? So the buildings that you are financing, where are they located? Are they located close to a river, for example, which is more exposed to a flood risk, or heat and drought risk, like we saw in the slide from Rainer? What would that mean for the economic activity?
And I'm really glad that I asked, because not only to learn, to know a better understanding, but we are talking about certain tools you can use for that engagement, and also coming and having this discussion in Central Eastern Europe. Some of these topics are even, maybe, I wouldn't say newer as such, but maybe, it's slower process of implementation, or maybe ownership of the topics. And I think this is also a really interesting, really important tool for the ECB to engage in these, or maybe create some kind of impulse for the banks to think and consider some of these risks. So this is really crucial. And then I will somehow try to connect it back to EFRAG and ESRS, but we are talking about data, and also Christopher mentioned about how data clearly are the main pillar or the stepping stone for good quality climate tests, which are crucial for actually understanding long-term risks. So very important. And then I would say that then this is the role of ESRS as well, and CSRD is to actually produce data, right? For companies to create more data in the market, so we can make better decisions, we can do better modeling, we can predict future better, right? And prepare for it. So, and you mentioned that back to the original point, Chiara, about your consultations and getting feedback from the companies. Now, because it is complex regulation, trying to produce a lot of data, you could argue, in terms of KPIs, in terms of different data points. So are there any main challenges now? Let's talk about bigger companies. So SMEs, it's really good to hear that. It's phasing in, but they still have a little bit of time. But in terms of bigger companies who have the resources, right? They have all these different compliance teams, data teams, and so on. What are some of the main challenges? Because especially here in the region, I do definitely hear challenges as well, and some complexities. So what's your experience when talking to companies? I think you may be on mute, just to check.
Indeed. Well, let's say that since March 2023, April, we started to also be active in the space of implementation support. And we immediately started to draft the first 3 implementation guidances. And we started from what we see are the most challenging areas of implementation of these standards. The first is materiality assessment. It is new for the companies that didn't produce sustainability reporting so far. It is new for those that produced it so far because it's not only materiality under impact materiality, but it's double materiality. And also because the fact that you move from voluntary to a mandatory framework makes responsibilities and data quality much higher. And so there is, for example, documentation to be prepared, the traceability, etc. So challenge in materiality. Challenge because it's an area of judgment. And there are several ways to approach this exercise. Some make use of hard data. Others involve more heavily stakeholders with surveys and focus groups. But I would say that in all cases, what is a good approach is to try to stay close to the strategy, close to the risk management, close to the sustainability due diligence, and this will give a good answer, not exaggerating with too many topics that are not really material, nor to have too few and excluding items that are material. So getting the balance right is a challenge. Another challenging areas is value chain reporting, because also in this case, you need to build an infrastructure of data. Now, what we have done in our implementation guidance on value chain is to demystify value chain and try to explain that what is really needed in ESRS is a hotspot approach to value chain. Only when it is needed in terms of exposure to impacts and as a consequence risks and opportunities, then the company needs to invest in terms of better understanding those impacts, its own value chain, engaging more with actors in the value chain. And for the time being, only 2 metrics, quantitative metrics, cover value chain at sector agnostic. More are needed at sector level. So this of value chain is a very difficult area, and we know we need to do more in terms of helping companies, and we are going to do it as part of our sector work. And then the third area is the selection of information that is material. Once the topic is material, what do I need to cover for each and every topic? Because if you look at the list of data points that we issued, those are almost 1,000, which seems a monster data, but still is much lower than what we produce for financial reporting. And out of those data, only a good 20 or 30% are voluntary. So if we look at the requirements, is only 800 or so. And also in that case, not all of them are needed, absolutely. Only those that respond to the material matters, and for metrics, only those that are judged material by the company. So explaining all of these, and we still see companies advised by consultants that start their gap analysis on the universal of this data. This is not needed because an excessive compliance with too many data points risks to obscure material information. So what we see in these 3 areas is that there is still still a lot of education to be done and support to companies. So that's also the reason why in October we have opened our Q&A. And we would like really this to become the channel whenever someone has a doubt on how to apply the standard, being it a preparer, a user, a regulator, or an auditor, please send us a question. We are doing our best to be as quick as possible. We have already issued 68 answers to this question, and 105 are covered already by the guidance that we have issued. And so far we have received more than 450 questions, and we are progressing as quick as possible to reply to these questions.
Thank you so much. Sounds really as a really active addressing of those challenges as well. Just the first point you mentioned, the implementation guidance documents. This is something really interesting because I obviously working on the topic. I was following the development of the ESRS closely since the start, and it's interesting because it is really, I mean, it looks really complex. It's a lot of data points, different standards as well, or different sub-standards. But then when you actually dig a little bit deeper, and this is something, as you said, like it needs to be communicated, there needs to be some education and discussions. That's why there's that materiality assessment. Like it's just really difficult to, like it cannot be emphasized more how crucial that materiality assessment is exactly to distill down to the most important risks that actually are important or relevant for the company. And this is something, to be honest, from my experience when talking to big companies or companies in scope, this is not something they always realize, and often that skepticism is also when they see the list of things. It's like, okay, that's so much and so complicated. But then we actually realize that they're potentially only material to like 10% of that. So it's really important to have that Q&A, I think, and to also see, I think it's really crucial for the companies to see that the US EFRAG are actively engaged in answering the questions, and the questions can be answered from the practical perspective. So these are really crucial points. I could go into all of these challenges, but we don't really have that much time. But it's really interesting to see how that value chain is definitely becoming a big discussion point, because it is cascading down and it's getting more complicated. But just to go back to you, Stefan, because I mean, as you mentioned in the beginning, so when it comes to EU taxonomy, in terms of how it started in Austria, how it's going to be, how the discussion is going, engagement with companies, it's really big. So the ministry are very involved in this, also talking to corporates, I assume, talking to financial institutions. But I would be very curious to hear, what is the outcome of this? Is it like, do all these discussions and findings and your experience with EU taxonomy and the data you collect, does it actually fit into some policy making?
Actually, yes. I mean, the first outcome is quite some material. I brought some with me, and if you're interested, you can easily check that out, or you can find it online and let it translate by an AI tool. I guess this shouldn't be a problem today anymore. Yes. What does it make a difference? I mean, we try to use taxonomy whenever we need ecological criteria, also for policy. So the taxonomy has the advantage of setting ecological benchmarks, and this is on different levels. You have substantial contribution, which is very high in ambition. Then you have doing a significant harm, preventing the harmful aspects, and you have this principle-based DNSH level where you can use it, for example, in different EU funds. And for example, we implemented this in one of our tax allowances in Austria. We used taxonomy criteria to benchmark ecological harmful infrastructure investments. We use it with our Green Finance Alliance. As you mentioned before, this is our voluntary commitment association of financial industry in Austria. We use it in our eco label. Umweltzeichen, you probably know, where we set up a voluntary taxonomy benchmark for this year, and we will have a obligatory benchmark starting with 2026. So we try to use it for different policy developments, and we try also to get more interaction with our subsidy department to have this connection between subsidy on the one hand and private finance on the other, because we see there is a great potential. You have credit institutions which want to increase their green asset ratio, and on the other hand, we have a public subsidy scheme. And if we have a combining criteria, then we have a lot of potential to increase. So I think there's lots of opportunities where you can actually put in place the taxonomy, and there's different ways. You only have to be kind of creative in using it.
Okay, so this is some really tangible examples. This is good to hear. Maybe something that people don't really, I think, realize, especially because we often talk about public and private separately, is that, so actually you mentioned subsidies. So for the EU funds being distributed in the EU, maybe some of you know that the DNSH principle actually was implemented in this as well. So to get EU funds for projects financing in the EU for member states, they actually have to comply with the DNSH, which is very much taken from the taxonomy. So it's interesting how it's now being, going into the public sphere as well. Green budgeting, for example, and we could go on and on. Christopher, any brochures from ECB? No.
Yeah, plenty.
That's okay.
I didn't bring them though.
Because ECB is paperless and ESG exactly. Good. And so we discussed climate stress testing and also actually now with the better explanation. But we mentioned that obviously data is used for that. But I would be interested because is it just data that it's very specific data you need for the climate stress testing, or for example, is it somehow linked to specific regulation? Like, for example, do you just, like SFDR, does SFDR, for example, as the regulation where you have specific KPIs and information from financial institutions, right? From internal policies and engagement and compliance and due diligence all the way to the PAI, right? Like, does this specifically, for example, SFDR feed into this, or is it different sources you mix?
I mean, doesn't specifically fit into it, but I mean, we see this really as part of a joint framework together with the sustainable reporting standards as well. So I think in combination, both of them will be a powerful tool to, say, enhance transparency, shed light on ESG risks and opportunities for the sector. And actually, we think that the enhanced disclosures promoted by the ESRS will also help our financial institutions to meet their own reporting requirements, disclosure requirements under the SFDR. So I think what is important from our perspective is also that, of course, that there should be no duplication across the different regulations there, but I know that ESMA and EFRAG are also speaking and aligning on this, but of course Chiara can speak more to that. But we see, say, these different reporting requirements very much complementary and supporting each other. So, but okay, yeah, doesn't directly feed into our own kind of assessments, but of course it's part of the broader disclosure regime that we think will be helpful for the financial institutions, but also for us as supervisors.
Well, exactly. So even, I mean, for those banks you work with, I suppose, for climate stress testing, because, and I think that is the main point for SFDR and CSRD to link to each other, right? Yeah. In terms of data that is being collected. I actually have not been tracking the time at all, and we don't have time. Exactly. I know, that's why I'm asking. There is a question. What is time anyways, right? Good. We do have a question. And this question, I think, is targeted mainly at Chiara. Are there any sanctions in place if a company will not report in line with CSRD at all, or if it's not compliant?
Well, the regime of the sanctions is one of the elements that is in the remit of the member states in the various decrees that implement the CSRD. So yes, there are sanctions in place, but it's outside the EFRAG remits, and it's in the work that currently I referred at the beginning to the fact that the CSRD is being now translated into local law via a series of implementing acts, and that's what is happening. And sanctions and audit regime, these are two items that are covered at that level.
That is a strong message, I think, for the end, that this is no longer voluntary, and there will be implications, because this definitely is a very much legislation actually being implemented. So this is, we get a lot of these questions sometimes in the region. So this it's good to hear that this is in the works now. Okay, well, apologies for overrunning, but it's a very interesting topic, and we could obviously delve much deeper into this. But I know that the speakers and panelists, apart from Chiara, unfortunately, are staying here for a quick snack, so we can still catch up. And so I thank you all of the panelists, Christopher, Stefan, and Chiara online as well. Thank you for joining us.
Thank you.
And thanks for the very insightful discussion.
Thank you very much, as we are quite beyond the shadow. But okay, it happens. I would like to invite Rainer Martin to wrap up the day briefly, and then
I promise to be very brief. So I have 4.5 points I would like to make. The first one is that at the very beginning about green investment, that this is something that is becoming more and more ubiquitous. I think you mentioned that, right? It's growing strongly. There's still not enough of it, but the glass, if it's half full, it seems to be filling up. So that's very good news. Then the second point I liked about the distinction between climate finance and regular finance, that this should actually be disappearing over time. So at some stage, we should only be talking about climate rather than having to, about finance rather than having to call it climate finance. The third point about the reporting requirements and the struggles that the companies have, I really like Chiara's point a lot on avoiding excessive compliance and to be measurable and reasonable in what you are doing, and the education process that is needed. And the fourth point is that, of course, the banks will be struggling and continue to be struggling if the corporate sector doesn't fulfill what it has to fulfill. I think this is a message that came out very strongly during these discussions. And the last half point, I loved your comment that complexity is a learning process. So next time my daughter will struggle with her mathematics homework, I will make sure to mention this to her. I thought this is excellent. Right, so let me finish now by thanking again all the speakers for making your way here to Bratislava and to share your knowledge with us. Let me thank ISFC again for the cooperation. Let me thank the NBS team, Jan, Roman, and Maria. I don't know whether you're here, not here, okay. And the IT team that made this possible, this event. And let me also thank, of course, the audience. Thank you for being here. And also the online audience for the interesting questions. And very, very last point, there is food and drink outside. I think quite a lot of it. So please stay with us, exchange more views and follow up on the discussion. And thank you very much and have a great evening. Thank you. Bye-bye.